Swaroop, so given that there's no consensus, what's the possible direction of travel for sustainable trade finance and perhaps its capital treatment?
Yeah, I mean, that's a very topical debate, right? And I enter into this debate almost every day with some institution or the other. And this is heavily being debated between at ICC, various regulators, policymakers. There is some very good work that EU has published, not just on trade finance, but on sustainable financing as such, and how regulators are looking at it. I think where the answer lies, and this needs more consensus, frankly, to be developed, because historically capital modeling and treatment has to be evidence based. And the primary objective of regulators is to make sure that there is no systemic risk that is developing when we are doing ESG transition, and also making sure that the institutions remain resilient. Therefore, we have to be very careful about the arguments we are making about capital treatment or preferential treatment for sustainable trade finance. I would I would rather say we should call it appropriate way or appropriate treatment of ESG or sustainable financing as such. ESG modeling, like I said earlier, has to have both historical as well as futuristic models now, and that is something that organizations and regulators have to evolve, that they actually envisage future scenarios, because most of these ESG risks will evolve in the future, and it's impossible to model them based on historical data, which has been the way to model defaults and capital regulations so far. But I think that needs to fundamentally change. I think institutions also need to create this data. So all these market players which are now developing methods of monitoring and doing sustainable trade finance, there is a lot of work that's happening from individual players, be it banks, financing companies, fintechs, and others, which are developing various tools. I think there's a need for all this to come together and sort of create a library of sustainable trade finance data, which can be used then for regulatory purposes in order to be able to then do stress testing on future scenarios. I mean, this is an ideal world. This will take more than one institution's effort for us to be able to reach there. But I think it is a call upon multilateral institutions and regulators and transnational institutions really to do this, because this will require a lot of intergovernmental support as well for us to be able to then develop these stress testing models which can be used by any financing institution for lending. So for instance, just to bring this to life for the audience, let's say you have sustainable supply chain finance being provided to various players, and you have monitoring data and historical data in particular markets which have been developed. This data then can be put on common libraries which can be then used for various laws and PD models, LGD models that institutions use based on futuristic trends of ESG. So there is a lot of work to be done in this space, but I think the direction of travel that I am seeing at the ICC Capital Treatment Working Group on Sustainable Trade Finance is that there is definite desire to collaborate. Second, there is definite need for us to develop data. So we are collaborating with ICC Trade Register to get this data together, which is the central repository on trade finance default data right now. And once we have these data flowing through, there will be more evidence for us to establish the riskiness of this asset class or the differentiated nature of this asset class over a period of time. But we have to combine this with regulatory dialogue that's already happening. And I'm very pleased with the work that EU has published. I've also seen Institute of Internal Finance also publish some work around this. So I think 2021 and 22 will see a lot of debate around this, and I'm very positive that this will come out.
Thank you very much, Swaroop, and Juan de Rocha totally agrees with you on the chat, and Gerald Bohm, hopefully that answers your question, although we'll talk about that roadmap in a bit more detail later on. And whilst you've got these excellent members, also some of whom represent the ICC Sustainable Trade Finance Working Group and the for ESG committee, please ask them questions whilst they're here now. Let's talk about the regulatory treatment of sustainable trade assets in a bit more detail. Katerina, how can we bring sustainable trade finance assets to capital markets, so pension funds, et cetera, and is standardization or definitions of sustainability criteria, is that the answer?
I have to say, Deepesh, the assets are already in the market. So, the banks are not the first one bringing those assets into the capital market, because there's a couple of funds, hedge funds, pension funds already in the market, which are doing this business, bypassing the banks. So that's first the point, and there is a market already. The problem, or the issue, is actually that those projects, and that comes a little bit to what Swaroop said, that those projects are perceived as being combined with a higher risk, because, as we said in the past, there was not a dedicated differentiation between green or brown, etc. So there was that the financial standing was the key factor, and of course the region. When you look now in the most prominent green projects, then you find them in regions like Africa, LATAM, emerging markets, of course, simply. That is perceived as a higher risk, and therefore there is another capital market actually assuming and swallowing this risk. So one of the tasks is, of course, besides standardization, which is clear, you need to have a framework. But besides that, we should work on making a little bit more transparent what's really the benefit of a solar project, for example. And that is not because it's probably paying more profit. It's simply because it will most likely stay still when you don't have any coal-fired plant. So it's a future-oriented business model. That's the point we need to make. And on the other hand, of course, we miss sustainable trade standards yet. That doesn't mean that we cannot leverage on existing standards like the green bond or the green loan framework. And those terms, they are quite familiar for those investment companies, pension funds, etc. They know how it works. So let's leverage on those things in order to bring a little bit more understanding for our assets class. Let's package and then bring the package to the market. There is a market already, including, by the way, private investors. So there is quite a lot already ongoing. And that is the point where we need to be careful now that the train is not bypassing us, that we are part of the game, that we are just defining the future for that and shaping it, and not wait until everybody is on board. That's actually, it's a critical time right now. And if we lose it, we may lose a really future-orientated opportunity.
Thank you very much, Katarina. Swaroop, from a secondary trade finance distribution perspective, how do you see the market developing, especially given the short-term self-liquidating nature of trade finance and where it's placed at the moment?
Yeah, I think what Katarina said is absolutely on point, right? This is the time where we have to collaborate with players outside the banking industry, capital markets, other participants. I think sustainability is a topic where we have to collaborate widely across the industry, be it fintechs, legal firms, and multiple players. And that's precisely what we are doing, not just in the ICC Sustainability Group, but also in the institutional investors in trade finance group, where we are trying to develop, again, bridges between the originators and investors for trade finance. And this is the common point that comes up, that how do we create formats which are accessible for investors? So that is something that we are doing for capital market investors to invest in trade finance, rather than to make it more accessible. For example, capital market investors are more familiar with securities type formats. Trade finance is not commonly sold in that manner. So that is something that we are trying to industrialize. We are also trying to develop the nomenclature which is common between capital markets and trade finance, so that we are able to make this more accessible, and people speak the same language, and we're not speaking different language on either side. And I think the biggest role here is also of technology to be able to really present these assets in a very seamless manner to investors. So for instance, you develop indices and then be able to access this seamlessly over a network of technology for investors to go and access. So today, capital market investors are very used to going to platforms and buying fixed income securities, for example. So we should be able to then say that trade finance is accessible in securities format. It has an ESG tag, and for which the earlier point I was making, something like an index or a score that comes up and be able to say that these assets are or of certain standard once we have the definition. So I think that is the direction or the end state vision we have at the industry level. But a lot of work is being done in this area, and there are some very good examples of early successes in this, including and I have also seen interest in the insurance market, for example, to do green insurance and sustainable linked insurance, and insurance players are now co-creating these opportunities with some of us on insurance structures for covering ESG trade finance sort of structures. So yeah, very exciting times, and I'm sure there's more to come on this.